From Colorado's news leader, this is 9 News Saturday Morning.
With Wall Street nowhere near easy street, a lot of Americans at a loss as to what they should do with their investments. So we've been talking throughout the morning with financial planner Peter Tedstrom with Brown and Tedstrom. He's here to help us a little bit here for the advice. And Peter, thanks again for being with us here in this next hour. I want to get to something that's interesting here instead of the gloom and doom, but the opportunities that are out there. And you were just mentioning here off camera, long-term interest rates. Now's the time to really look into this, explore that.
Absolutely. Rates are down, particularly for those that are not jumbo loans, that are conventional conforming loans. People can get less than 6%, probably around 5.5%. A lot of people don't realize that they can drop their mortgage rate by maybe 1 or 1.5% right now.
If your credit is strong and you have a good score, you're still in good standing. The banks like you. They want to lend to you.
They want to lend. They are looking for reasons to loan money to people that have good credit scores that they can rely on that are going to pay those debts back.
The way it was back in the day, right?
Absolutely.
Before the lending standards here really
whenever
went
that day
out of
was. It's hard to remember.
Yeah, right. Looking around, just reading here at some of these websites that rate these average credit ratings here to get the best rates right now on credit cards. Looking at the high score, 786. I mean, you really have to have it.
You've got to be diligent. You've got to keep track of those loans, make sure that you pay them on time, and don't try to skip a payment. Don't try to get by with something because they're going to catch that, and your credit score is going to come down.
And what about equity line of credit? How much is that changing now rapidly on people?
Well, those rates are low as well, but people can look at their equity lines of credit. They might be a little bit higher than the current prevailing mortgage rates, and they may be able to wrap that line of credit into their first mortgage.
Now, with the news we're hearing today, these countries here, about 20 nations, and eventually later today we'll meet with the Treasury Secretary. It really is tied in globally here, isn't it? I mean, not just a problem with our banks here that we're trying to get to lend again to each other and ease this credit crunch, but worldwide. Just explain to us in layman's terms how it translates to us, the consumers.
Well, I think what happens is that we realize that this problem is far greater than what we've got here in our country, and we've got to work globally to figure it out. Last week, there was a global reduction in interest rates, and that type of effort is going to be needed to get us through this problem.
And you were telling us in our last hour, just on a time frame of things, when we can see an ease in the restriction, when we're looking for that car loan and have some better chances at getting it with the home loans and so forth, that it's probably going to be a while, a few months.
It's going to take some time. This is a major problem that has to be worked through the system. If it happens within 12 months, I would not be surprised. It might happen in 6 months, maybe 18 months.
And briefly, real quick, we're done here, but the presidential election, how much does that play into it, regardless of who wins the presidency, with an economic policy on this?
Well, there are a couple ways I think about it. We deal with the stock market on a regular basis, and uncertainty is something the stock market hates. So when there becomes more certainty within the environment or the economy, then people will start investing and feel more comfortable utilizing their debt and their cash flow.
So that plays a factor. A new guy in the White House, then it's kind of a confidence issue again.
Absolutely, no matter who gets elected.
Yeah, okay, wow, something to look in. Peter Tedstrom, thank you very much.
Thank you, Sean.
Appreciate it.